Welcome back to the channel, guys. My name is Gordon. We are back with another video. Today, we are joined by very special guests on the channel. We've got Victor and Erkin from Subnet 35 Cartha in the Bittensor TAO ecosystem. A big welcome to both of you, Victor and Erkin. I would love to start off by just maybe setting the foundation and giving everyone watching here just a brief introduction to Cartha as a subnet on Bittensor, and then maybe explaining a little bit about 0x markets and what you're building with that perp dex. So yeah, really just a nice background for anyone watching, and then we can kind of get into the details.
Sure. Gordon, thanks very much for having us here. Great to be here.
Sure, my
Let's
pleasure.
do a quick introduction from our side. So I guess taking a step back on how we all sort of got together. Essentially, I'm working one of the co-founders and CEO of 0x Markets. And I partnered up, was lucky enough to partner up with GTV and Taoshi, who were building the whole ecosystem with together. And considering my background to traditional finance of over a decade and institutional and retail crypto, and then most recently retail CFD space of which is majority of various assets.
Mhm.
Um, I've noticed a gap in the market, and I started talking actively about this to the friends. One of the first guys was Victor, and we started discussing the subject a long time ago. And then sort of interest aligned right about the time when I decided to leave the CFD space, and we started building this together. So the idea came together from sort of alignment across the board that we're missing true permissionless markets, and markets are not truly aligned with for the interests of the actual participants.
Mhm.
And whilst a lot of participants are bringing tremendous amount of value to the market and bringing liquidity, they're not getting what they contribute out of it, right? So there's lack of fairness, there's lack of permissionless approach, and lack of fairness and transparency in the market. So that's what sort of kicked it all off. And I'll let Victor do a quick introduction and talk about the Carta side of the BitTensor.
Yeah, also Gordon, thank you so much for having us. Really glad to be here. So in terms of myself personally, my background is similar to Erkin. So ex TradFi, used to be an investment banker. Been reformed from that for about 4 years now. Uh, and so really where I work at is GTV. Well, first and foremost, we are a subnet incubator. We've helped develop 5 subnets on the ecosystem, and our goal here with Cartha was really to kind of rethink kind of some of the fundamental ideas of how you can leverage the Bittensor orchestration layer to actually get to the positive externalities and kick off the flywheel of a marketplace. And so the goal of the subnet here is that miners are asked to compete to lock up as much USDC for as long as possible.
Mhm.
And by doing so, they provide the B book or the liquidity for the 0x Markets exchange. And really, the vision here is to create this flywheel where, on one side, we're able to incentivize miners to bring their liquidity across from other networks into Bittensor, and then that liquidity then gets translated into 0x Markets, where that liquidity then gets used by traders that are utilizing the platform that then pay yield that then gets distributed back to the miners. The interesting thing in terms of the design of how we've designed this is that miners get 100% of the opposite side of the P&L of the traders. So for example, if a trader wins, miners lose, traders lose, miners win. And then they also get 50% of the protocol trading fees. So of the trading fees that are charged in the interactions with the protocol, 50% of those go directly to miners. And then of the remainder, 10% goes to us as ongoing protocol fees to maintain the protocol, and 40% goes to alpha token holders that are staking their alpha tokens in a
Mhm.
vote escrow contract mechanic. And really, the vision here is to create a system where all sides are incentivized, whether you're a miner, whether you're a trader, or whether you're a speculator that's just holding the alpha tokens. You have that ability to benefit from the ecosystem across the board. And we really want this to be really a showcase of how you can use alphanomics to kick off this flywheel, where on one side we solve for the supply side, which is the miners providing the liquidity.
Mhm.
Then we also solve for the buy side of the traders by also incentivizing them on by using the platform. And then the last part is really is incentivizing the network and giving a use case for the alpha tokens, where even if you're not necessarily a trader or a LP in the protocol, you're actually able to benefit from the protocol itself through owning the alpha tokens.
Mhm. Awesome. Okay, Victor's diving straight into the mechanics. I love it. I definitely have more questions on some of the intricacies about the, the miners versus the traders versus the stakers. But just before we tip into that, um, what was the motivation for going down the perp dex route? Because over the past year or two, we've seen Hyperliquid come on the scene,
Mhm.
taking a lot of market share from centralized exchanges and futures trading over there. Is it a pattern that you've seen traders want to be moving towards self custody and using perp dexes in favor of centralized exchanges? And obviously, we've seen the likes of Aster, Avantis, and other perp dexes, and that meta kind of being very strong over the past few weeks. Could you maybe just touch on kind of the reason there? And
Yeah.
yeah.
So look, uh, take a step back for a minute. Perp dexes are not an, is not something new.
Hmm.
GMX has been there for a while. DYDX have been there for a while. Hyperliquid, whilst they gained popularity more recently, also are not a new DEX. So there's several narratives here, and one of the most important factors is that whilst crypto was creating a lot of waves and innovation in the space of trading, in the space of how people hold their assets, how people interact and transact with each other, TradFi sort of fell behind, and the only players that were servicing retail-facing TradFi products or bringing those sort of products to the market are centralized CFD brokers. So let's say today, if you want to trade currencies, gold, commodities, anything you want to trade, 99.9% you're going to end up with a CFD broker,
Hmm.
right? And you don't know how they take the liquidity. You don't know how they price it. You don't know where do they hold the assets? Do they segregate your assets from others? You can see the numbers changing in your account, but you don't really know, can you extract those assets at the
Hmm.
moment you click withdraw button, right? I'm pretty sure there's a number of players out there that are fantastic and people are very happy with them and so on and so forth. But the industry has not started that way. And there was a lot of, and they still are, a lot of scam brokers whereby the only button that functions is deposit,
Hmm.
right? So if this mechanism works for trading in general, it doesn't really matter what you trade. You can trade crypto, you can trade apples, you can trade oil. Exactly the same thing, right? And we know that traders want leverage, right? Because as retail participants, we don't have millions of dollars in our accounts, um, and a great deal of risk neutral strategies or the ability to execute institutional level strategies. So people are playing with smaller balances, smaller deposits. Yes, there's quite a number of whales, but in majority, it's thousands of dollars, not millions of dollars, right? Um, and this is where the interest comes, whereby even on centralized exchanges, majority of the volume done is on perpetuals. A
Hmm.
lot of exchanges treated spot as a product to attract users, then convert them to leverage trading, and that's where the actual revenue happens, right? So we know that's the product in demand, right? And the idea behind 0x markets is to bring variety of markets and not only limited to crypto, right? So we're turning tables in terms of how the users interact with an environment and how does the environment work and what role can a user play in the ecosystem. But the actual assets they're interested in, still the same assets, crypto commodities, currencies, and so on.
Hmm.
Leverage is still sort of the ability to use leverage trading, and all of that comes together with sort of perpetuals.
Okay.
And as Victor mentioned, with the power of, I believe Bittensor is probably the best incentivization layer in digital assets, full stop.
Hmm.
And the way the whole logic and the subnet ecosystem is created is fantastic. And we thought that considering um, the value we're trying to bring to the market, a fantastic way of incentivizing users would be through a tried, tested, and proven incentive layer,
Hmm.
uh, with whom we're lucky enough to have fantastic relationships and connections in. We know inside out through our partners, and that's why Cartha.
Awesome. Okay. Yeah. Thank you for that extra context. So, double clicking into that incentive layer that is TAO and the liquidity as a service model again, and maybe this is more for Victor, but you spoke a little bit about the miners being the liquidity providers for Cartha and for 0x markets. We're seeing a similar model with some other subnets at the moment that are not necessarily perp dexes, but I'm sure you're aware of Swap and TAOFi, where you can provide liquidity and then you're also getting incentivized and earning rewards from the emissions on that subnet. Same thing with Void, but they're doing it with cross-chain CCIP, where you can stake on, you provide liquidity on Radium, you stake your NFT, and you're mining there and getting rewards. Um, what is what is maybe similar to what you're doing there with your incentive model, and then maybe what's different? Because I think you touched on a couple of points that might be a little bit different, Victor. So I'd love to just understand that on a little bit of a deeper level for anyone who's thinking about being a miner slash liquidity provider.
Yeah, no, absolutely, and I think the this direction of travel that we've seen recently, and I think recently, I forget who posted the tweet on it, but talking about high margin subnets of kind of subnets that are more focused around providing liquidity and the kind of the DeFi applications is a narrative that is happening in Bittensor, and we're really excited to be part of that narrative. I think in terms of where we're similar to other subnets that are thinking about this is that we do have the fundamental part where the main action we want the miner to do, and we want this to be dead easy, is provide liquidity just like you would in any other DeFi protocol. And
Mhm.
that's your absolute base requirement to be a miner is that. So no requirement for hardware, no requirement for complicated AI knowledge. It's really, if you have USDC, you can become a miner. And I think that that is a great thing for the ecosystem, that that's become a narrative. Where I think it's a bit different to the others, and I think this is probably where we overlap a bit closer to Void,
Mhm.
is that our goal was really, we realized that there's an opportunity to become a liquidity as a service layer where we could theoretically, and in our early design iterations, one of the ideas was, let's create this layer where we can now apply this liquidity into DeFi and across the ecosystem, right? Whether it's on Base, BSC, Ethereum, we could essentially then route that liquidity into DeFi use cases. But when you take a step back and you look at that, how is that particularly different from, say, a Pickle or Harvest Finance, those yield aggregators from the early days in
Mhm.
DeFi 1.0? There wasn't really a narrative that kind of was turning the lever in a material way. And so we took a step back and said, look, what if we built our own platform on top of this to be the showcase for this liquidity? And then create these mechanisms where all participants in the network are able to benefit from that liquidity coming through. And that means not only the miner that is providing the liquidity for the emissions, but how do we create an incentive such that miners are not incentivized to sell their emissions, and at the same time create an avenue for where token holders or speculators are able to just buy the alpha tokens and then benefit from the protocol that liquidity is being driven towards. And so, in terms of that idea, that's really where we came up with the structure where, of the protocol trading fees, the miners earn their alpha emissions. They earn that on a pro rata share based on a scoring mechanism that is determined around how much USDC you're locking up and how long you're locking up. And when I say locking up, we actually mean time locked. So this is also solves another DeFi issue of uh, liquidity that's easily movable. In terms of our exchange, we now have guaranteed liquidity on it. And then the second part here is that those emissions that they earn, they also earn the protocol fees, and they only earn 50% of the protocol fees by becoming a miner. The other 50% of the protocol fees are split 10% to ourselves as a protocol for ongoing maintenance, marketing, etc. And then the remainder 40 is for anybody who is also staking their alpha in a vote escrow mechanism. And
Mhm.
so this is similar to the curve model where you're able to lock up your curve. And in this case, you're going to be able to lock up your alpha. The longer you lock up your alpha, the more alpha you lock up, the more score you get. And then that determines what your share is of the protocol fees. And so this now drives the value of that liquidity and splits it into two parts, where one goes directly back to the miners for the work that they're doing, but also creates an incentive where miners are incentivized to lock up their emissions to earn the remaining 40%, but also creates a base demand for the alpha token where, if you yourself maybe don't have the USDC to mine, or you're not interested in getting into that side, you just want to earn the yield from the protocol, you can just buy our alpha tokens and then lock that up and earn the protocol fees that way.
Okay, I've got a couple of clarification questions on that.
Yeah.
Um, so, as a liquidity provider, sometimes the I'm speaking on my own behalf, but other liquidity providers as well. I think sometimes maybe frustrated is the wrong word, but we like to be able to have our capital as liquid as possible and get it out of a protocol or access that capital on a whim if necessary. And so you're mentioning the fact that if a liquidity provider or a miner is adding liquidity on 0x, they're going to be able to lock it for a duration in order to potentially receive even higher rewards. So I'm assuming or guessing that the longer I lock it for, the better rewards or the more emissions I'm going to earn, and the shorter I lock it for, the less I would potentially earn. So could you maybe just touch a little bit on that? And is there minimum time periods for locking? Yeah, how will that work?
Yeah, so really the idea here is that we want to make sure that there's alignment in the protocol, right? I think that one of the challenges with DeFi that we've seen historically, and especially, vampire attacks kind of like highlight this risk, is that liquidity is very is very I forget the word, but it can move quickly,
Hmm.
quickly between networks. And I think that that is both an advantage and a risk in terms of protocol stability for the long run, because at the end of the day, there's always a challenge where, for example, if liquidity flees from a protocol, you end up with a lot of users that are looking to use that protocol, but now they don't necessarily have the liquidity, which means that you're not able to guarantee that stickiness on the user side, right? So the
Hmm.
trade-off there is that to give the users that certainty that they are going to have liquidity tomorrow, we are asking traders to lock up. And exactly to you, to how you said it, the longer you lock up for, the more rewards you get. And there will be a minimum lockup period, but that will be closer to a day. So if you, for example, are somebody who wants to have the ability to move your liquidity quickly, you can come in, lock up for a day, but you will not be earning as much rewards as a user who's trading maybe a similar or lower amount than you that is locking up for upwards of a year.
Yeah.
And therefore, that's really the balancing figure of how we want to structure this in such a way that we always make sure that the incentives are aligned with the protocol on the LP side.
Yeah, totally understood. On a practical level, when 0x launches, and maybe you can give us some insights on the timeline there as well. If I'm connecting or wanting to provide liquidity, will I have the ability to connect an EVM wallet? Will it be the Subtensor EVM? Will it be a native TAO wallet? On a practical level, what does that look like for liquidity providers and miners once you launch?
Yeah, so we're working on a very abstracted mining interface. So it will the end goal here is to have a very simplified miner interface. 0x Markets is actually being built on Base.
Hmm.
And so the way that we're going to structure this is in such a way where you're providing liquidity on Base. The 0x Markets, your average user, candidly, unless they really are paying attention to the whole stack and they're just kind of coming to 0x Markets blind, they don't even see the Bittensor side of the fence. And our goal from the miner side is also to abstract that as much as possible, where that liquidity will be provided on Base and then the rewards are earned on the Bittensor network. And so that's really the split there, but it's really focused on how do we create this in such a seamless experience where binding is as easy as possible.
Yeah, awesome. Okay. The other thing I just wanted to clarify was you mentioned the fact that miners are providing liquidity and obviously earning rewards for doing so or emissions. And then you also referenced the ability for further emissions by locking up the rewards that miners are getting. So would that be over and above just the native staking yield that the Cartha Subnet alpha token currently gives? And yeah, basically, if I'm a miner and I'm earning emissions in the Subnet alpha token, and then I guess, restaking them, I'm earning additional yield compared to what I would be from just normal staking. Is that the idea?
So let me clarify
Mhm.
the kind of the revenue structures from a miner perspective. So if you're a miner, you provide USDC, you lock that up, you earn two types of rewards. One reward is that you're earning your alpha emissions. That is coming in to on your Bittensor side. The second reward that you're earning is that you're also earning the protocol fees in USDC to
Yeah.
your wallet. Of the protocol fees, as just a pure miner who's not doing anything else, you're only earning 50% of the protocol fees are being routed directly back to you as a miner. But if you, as a miner, restake the alpha emissions that you earn, you're able to claim a share of the 40% of protocol fees that go to alpha token holders. And that's really the structure there. Now, in terms of the mechanics of how your alpha yield, in terms of your normal alpha staking yield that you earn, that will be passing that through whenever you lock up your alpha. When you unlock it, there will also be the native yield that's built into it. We're working on the mechanics behind how that's going to work. But fundamentally, the additional rewards that I was mentioning and referring to here is really the additional protocol fees that you can get a claim of the share of.
Yeah. And will miners have to manually go and restake that, or will they have the option to, let's say, have those rewards automatically restaked to just have that flow very seamless?
So our goal will be to get it to very seamless. I'm not sure what I can commit to. I think I'd have
Sure.
some quite upset engineers if I commit to that here right now. But our goal is in the long run is to have everything as seamless as possible. And obviously, little things like this are quality of life improvements that will, if it's not available on day one, it's definitely something that's going to be on the docket for future iterations.
Yeah, for sure, for sure. Okay, I saw a couple of other conversations that you guys have had, and it seems like initially focusing on FX markets is the focus, and then expanding from there. Will there be the ability to trade crypto from day one, or will it simply be FX and then you'll expand and grow it out? Some other categories, real world assets. We've seen other perp dexes like Aster now allowing you to an Avantis, long and short commodities, even the Mag 7 stocks. Yeah, just curious on if you can give us a little flavor for what we can expect in the first few months.
Sure. So we're planning to launch with essentially three asset classes:
Mhm.
currencies, commodities, and crypto. So
Mhm.
from commodities, we'll start out with metals because that has sort of the most amount of demand from the market. In the beginning will be a sort of a beta version. We'll start with just the absolute majors and a few assets to bring out to the market, with the view of iterating this quickly and achieving several hundred assets of various types. So very interesting for us is essentially crypto commodities and currencies as well as indices. In terms of the actual stocks, we'll come to that, but I think bringing the most traded and most speculated assets to the market would be very, very interesting. Considering there's a lot of already tokenized stock options out there and very centralized exchanges too, which is used as an innovation in this space.
Mhm.
But this side of the spectrum is still lacking significantly without any competitive pricing and execution quality available of these assets.
Yeah. Okay. Awesome. Awesome.
And if I may add
Yep.
something just quickly just on that, I think one of the interesting things of why we're thinking about FX first and kind of focusing on this approach, I think one of the really interesting things in the ecosystem is perp dexes have exploded because crypto users want to be able to trade perps, right? And I think that's a market that is constantly competing across the same pool of users. And really, the goal for us here is that if you look at crypto versus the broader FX market, the FX market is so much larger than crypto is today. I mean, even a smaller exchange, FX exchange is still doing quite a multi order of magnitude larger volume than Binance is on any given day. And so our goal here is really to kind of approach this the other way around, where how do we create an application that is really user friendly for your Web 2 type user? And that's really the reason why we're going to base first, is given all the work that they've done on the base network to actually onboard your average user, bringing that in completely integrated into the base app and simplifying those streamlined processes.
Mhm.
That's really the goal, is to get them to something that they're already used to. So migrating them from a CFD brokerage to using 0x markets,
Mhm.
and then slowly adding the crypto elements on top of that, rather than kind of scaring them with, SHIB, INU, and kind of all these other tokens where they suddenly get almost the too much choice and they kind of get stuck.
Mhm. Yeah, it can be overwhelming on some of the perp dexes with the amount of opportunities that are there for sure. So just another clarification question. Victor, you mentioned about the fact that at least to begin with, the liquidity providers will simply be adding USDC as the counterparty risk token, I guess, on 0x markets. So in that way, just again for clarification, there is no directional risk. So they are simply providing USDC and then generating fees based on that. Because on other DEXs or GMX, for example, the pools on
Mhm.
GMX where you're acting as the counterparty, well, in the V2 pools, you're not really taking on directional risk, but on other protocols, when providing concentrated liquidity, you have that directional exposure. I just want to clarify that there is not that directional risk or exposure there. And then in future, is there going to be other mechanisms or potential ways for LPs to provide liquidity that may have directional exposure?
So essentially here, think of it this way. For anyone to execute any sort of buy order, somebody needs to sell, right? This is the job of a liquidity provider, right? So the liquidity pools are there to fulfill orders of the clients. Now, this might come across scary at first, but the reality is, so if you look at the traditional brokers, CFD brokers, there are several types of sort of risk methods that are used. There's a book, which is fully hedged, risk neutral approach. Any client order that's traded is hedged in the market, is in exactly the same magnitude. There is a B book, which is a full warehousing of risk, whereby no hedging happens at all, and the broker faces the client as a counterparty. And in the C book, where this partial hedging happens depending on certain scenarios and certain sort of triggers.
Mm-hmm.
Now, in this instance, we're bringing up in majority of the successful brokers, you'll come to a conclusion that they're all B book brokers. And the reason why is because of the amount of spread they want to capture, right? Because essentially, if you're trading, let's say there is a spread of $10 on Bitcoin, and the client has crossed when they executed the trade, and you crossing a $5 spread in the market, you just only captured $5 remaining, right?
Mm-hmm.
And if you capture the full spread, you have $10, and that stays in the pocket. Now, there is a wrong way of thinking sometimes that I've come across a lot, whereby people think brokers make money when users lose money. On a given day, week, or say a month, this could be true. But if you look over a longer period, and as a general statistic, that's absolutely wrong. And the only thing that the B-book broker makes is a spread revenue.
Mm-hmm.
Unless they participate in any kind of dubious activities, it's a different story. But let's say fair markets game, right? And there's a condition to this of not having just one client or two clients on the platform and having sort of a healthy mix of customers. And this is exactly the same story that's happening here, whereby liquidity providers, so liquidity pools, they're managed by virtual AMMs that execute client orders based on dual oracle pricing mechanisms, and obviously with LP protection mechanisms baked in, with oracle failure mechanisms baked in to make sure that the system, to make sure that neither trader nor the LP fails because of a system failure, right? And once this sort of starts becoming a system that runs in a healthy way, LPs start capture spread revenue alongside with the various fees that Victor mentioned in terms of incentives. But it is a principle. LPs here are the principle against the trader.
Mm-hmm. Okay.
Right? In future, the way we're thinking to evolve this ecosystem is this is the first step. This is the first step of us bringing zero external markets to the space. Later evolutions of this will see us turning into more of a central limit order book type approach, which will allow various other players to connect and market make and provide liquidity directly without necessarily having to participate through Bittensor if they so desire. Alternatively, they can continue to use our Oracle and VMM driven logic, which is working the same way as we described now. And potentially we will expand this into several types of risk pools, whereby risk managed in different ways. It could be with smaller returns, we have a fully delta neutral strategies running in terms of market making.
Mm-hmm.
But these are sort of further expansion plans that we can explore, that we can work on. In the beginning, this is we stuck to the principle of the market and how a healthy market works and replicate building that out as a version 1.
Okay.
And then we expand this out to involve other potential interested parties and expand opportunities and possibilities in this ecosystem.
Okay. Awesome. Awesome. So I'm not going to hold you to it, but is there a launch date in mind? Are we kind of expecting 0x markets to come online in October, in November, before the end of the year? And I can obviously leave a link in the description for anyone to check it out because you can sign up for the wait list at this moment. Yeah, any insights on that over the next couple months?
So we're working towards bringing out a beta version this end of the year, this side of the year.
Hmm.
Wouldn't call a date specifically, but that's what the guys, the teams are working hard towards. Um, and then with some iterations coming early next year to expand and to give more functionality and sort of products for the users. But again, the main focus here is to bring out a product. It's better to delay it by a couple of weeks, but bring a product that the users will actually use as opposed to sort of unfinished thing. That's why I don't want to commit to a specific date just yet. But that's the aim. That's what we're working towards.
Yeah, and just if the engineers are watching this, if they want a Christmas holiday, they know when to deliver it by.
Exactly.
Christmas Eve, we'll be going live.
So,
Tried to be a good cop once in my life, didn't work out.
Awesome. Well, look, thank you guys very much for taking the time to have a conversation today. I think it was very insightful. Like I said, I'll leave a link for Cartha and 0x markets in the description. People can sign up for the wait list. Anywhere else that you want people to check out, or anything, anywhere you would like to direct the audience to keep on the pulse with everything you're doing.
yeah, join us on our Discord. We have the links on our socials as well, so follow us on Twitter. Join our Discord. Always happy to have any questions or comments on the kind of the architecture on the Cartha side in the Bittensor Discord as well. Happy to discuss that there. And also available if you tag me on Twitter. Can't promise I'll respond right away, but I always do try to respond to questions as much as I can.
Awesome. Yeah, well, Victor and Erkin, once again, thank you very much. I'm excited to keep on the pulse with everything happening here, and I'll definitely be providing liquidity as soon as I can. So,
Fantastic.
yeah, appreciate your time, guys, and we'll get you back soon.
Thank you,
Thanks for
Gordon.
having us.